right, thanks Julia. Thanks everybody for attending. George Saber, I'm going to be your speaker tonight. A little bit about me. I'm a founder of Coin Observatory. We're a top-ranked trading community. We also build trading systems. I'm an author. I used to write for FX Street. I got my top finance author badge on Medium in 2019, and then I kind of slowed down on free publications. And my most notable things I've written, like I predicted a few bull runs and a few market tops. So in 2019, I gave BTC a week on March 31st for the market to turn, and within 2 days we saw the first major up candle. And then I wrote on the gold bull run in 2019 and COVID crash. I wrote about an incoming big market crash in December 2019. That was because we were technically missing a retest, and I will explain what that is as we go through the slides tonight. And that happened just 2 months later. Here's a little like a brain teaser for everybody, right? What does, and speaking of everything being random, where'd Julia go? There you go, sorry. So what does the Milky Way, the human body, a surfer, and DNA have in common with each other, right? Yeah? You guys think about that one while we're in pause, please. All right, everybody think about this question, right? Like, what does the Milky Way, a DNA strand, a surfer, and the human body, what do they have in common? Mic test, mic check, mic check. Mic check. Is that better? I can't beatbox, I'm sorry. All right, so where were we? What does the Milky Way, a DNA strand, the human body, and a wave have in common? If we break down their structure into ratios, they're all based on this specific sequence of ratios, which is the Fibonacci sequence, right? And not just the golden ratio that somebody said, just 61.8, but there's a 38.2, there's a 50%, there's a bunch of ratios, and we're going to go into those, right? We're going to go into those tonight. Now, what does that have to do with financial charts, right? Financial charts, they do follow the same ratios, right? And that's the Fibonacci sequence. Now, I won't be giving you a history lesson in these numbers in their application, and I won't talk about the math. Can you guys, is this the mic working? Yeah? Okay. Mic, whoa. Further? Further, like this. Okay. All right, perfect. All right, so the same sequence is also present in financial markets, right? And I like to refer to it as a universal order because structurally, a lot of things when we examine their structure and the mechanics behind them and how they unfold, they do follow this sequence. Now, I was saying I'm not going to go into the history and I'm not going to go into the math of how we get these numbers because in terms of the market, as long as you understand how to use the tool, it does all the math for you, right? So there's no reason for us to sit there and try to spend time on that. Now, if there is an order to markets, if there is an order to everything, does that make markets predictable, right? And earlier we were kind of getting that notion of they're random. Well, I don't think they're random. I think we get some random fluctuations, some random moves, but in the big picture, I think they are predictable. And this is from my most recent paper. I wrote this on March 31st, 2021, when Bitcoin pulled back from 60K plus, and it was at 30,000. And I highlighted 3 different scenarios, and one of them was, or sorry, 2 of them were bullish, and the other one was saying we might go to 24,000. But 2 out of 3 scenarios called for BTC to retrace back up to 48,000, right, like 48,338. We didn't quite get to 48,338. We got like 48,000 and then some. And that was just last weekend, and the market started pulling back, right? And the way I got to this conclusion, right, it wasn't like alchemy. I don't think it was luck. It was just basically studying how the charts have moved in the past, right? Because they do follow a certain order, and that allowed me to make some models and how they're going to move in the future, right? And an example of that, I'm going to do some BTC examples, right, but also use a lot of other assets as we go on. A lot of people are familiar with this chart. This is the 2016 to 2017 bull run, right? And what might look like random, once we add these lines, right, these extension lines, retracement lines, the yellow lines on every swing going from a swing low to a swing high, we got to pull back to the red line, right? And we got that one time. There's a smaller one here, right? From a 1 to a 0 back to the red line, a 1 to a 0 back to the red line, and so forth. A 1, 0, red line, a 1, a 0, down to the red line, right? And that red line, that's a 61.8 retracement. That's that golden ratio that somebody mentioned earlier, right? We got a 1, 0, back to the red line, a 1, a 0, and this one was a 50% retracement. But overall, we had 7 61.8% retracements in the matter of a year and a half, right? Almost 2 years. So does that give us some kind of model so we can interact with markets in the future? I think this is like basically a schematic, right? And I'm going to be talking about I'm going to explain how to use this tool so you guys can actually, so. Okay, is this better? All right. Now it's feeling official. Here, you can have it.
I don't know why this is set up.
All right, so we do get these same moves, right? And they happen on all asset classes and on all time frames. This is in terms of a macro scale. It kind of sets the picture of why I made that prediction of going to 48,000, because basically the inverse of that. And there's also various methods to use this tool, right? Here I'm comparing two market crashes, right? This is a weekly chart on the S&P. This is a daily chart on BTC. But if we look at the green line, right, going across the resistance there, once we had a breakout, the price went above, came back down and retested it. From there to that high, right, where COVID was, we go from 1 to 0, right? Down to the red line, and the chart rallied back up. Conversely, right, when BTC went down from like 60K to 30, right, I had a 61.8 drawn there too, right, and that's where we got that first bounce, and I wrote about possibly going to 48, or most likely. And the way the method that I use to get these retracements, it's basically the same. And I'm going to cover some more of those methods a little further in. Before I do that, right, before I go into charts, everybody here has a different level of understanding of charts, so I'm going to cover some basics. I won't take too long, and just so everybody's caught up with the terminology, so if I say something, you know what I'm talking about, right? There's several chart types. There's a line chart. You probably see that on your Robinhood. There's a bar chart, candlesticks, right? There's Fibonacci. It's like a combination of moving averages or averages per candle. There's Renko. There's point and figure. All you're going to see tonight is candle charts, right? I think they're actually the best charts for trading these days. They do have a really good layout. Moving on, so candlestick terminology. So a lot of times I tell somebody, hey, show me your daily chart, and they show me their chart for just today, right? And that's not what I'm referring to. So when I say a daily chart tonight, I'm going to be referring to every candle on the chart as one day. Right, and you're going to see the time frame in the background, right? So 1 day time frame, that's going to be a 1 hour time frame. So every candle is 1 hour's worth of price action, right? And it's going to be a weekly one. So every candle is a week. So when I say weekly chart, it's going to be a really macro chart, right? Where every candle represents a week of price action. The open, the close, the open is the opening price, right? With a candlestick. With a standard candlestick, right? So it's going to be where the body of the candle is solid and where it starts on a blue candle, and it's going to start up high on traditionally it's a red candle, but it's a white candle in this case. And that would be the open, that would be the close on a bearish candle, and this would be the open and the close on a bullish candle. Now wicks, otherwise known as shadows, that's going to be extreme price action, right? Extreme price action is going to be price action above the open or below the close, and that's the inverse for bearish candles. It's going to be price action outside of the open and the close, right? The reason we call it extreme is because price didn't settle there for the close. It got rejected back down, right? In this case, it got rejected back up. Here we have really big wicks. And when we're using the tool, the Fibonacci tool, we're going to be placing it on the wicks because we want to get the gauge of at what everybody was thinking, what all the market participants were trading. Some more terminology. I got, I think, 2 more slides of terminology. So a pivot is going to be a change in direction, right? So that's going to be a pivot on a macro scale, right? On the weekly, that pivot created that move down. Here we have like 3 little pivots, but when you look at it, right, if you didn't have all that price action, you see price go back up, you got a pivot there, right? A pivot. So pivots are going to be a change in direction of a trend. A range is going to be defined as 3 touches, right? At 3 touches would be like 1, 2, 3, and now we have a nice range where the asset is ranging. A breakout would be, it can happen to the upside or the downside, right? It could be a bearish breakout or a bullish breakout. In this case, we're going to talk, this would be a false breakout, right? A break below the range. And interestingly, I'll show you guys how you can get a long signal or a long entry on something like this at the end of the presentation. But for now, so back to a range break, this would be a breakout by price going up above the range. A breakout retest is really important. That's when price will retest either top down or bottom up. Like on this was a failed bearish retest, and we continued up. This is a successful bullish retest, we continued rallying up, right? And then this whole thing is a range. Swing highs and swing lows, that's going to be the most extreme wick high of that range or of that move. So if something goes up and it does like a really high wick on a range, right, that's going to be our swing high, that's going to be our swing low. And going back to those wicks, that's where we want to place our fib tool when we start using it. The fib tool, if on your charting platforms, it's going to be this little tool right there. Traditionally, when you lay it out, it's 2 clicks. Your first click is your 1, your second click is your 0. If at a couple of slides, you might want to take some notes on when to put your 1 or where to use your 0, right? Where you want to place them to measure retracements and extensions. This is just for aesthetic purposes. So when you use your fib retracement tool, initially, it's going to have a bunch of colors. I'm not a fan of that, right? I think it's just too much visual data. I like to simplify things, and I make mine look like this, right? I think it's a lot cleaner. The 4 colors actually change, or the 5 levels actually change. So I change everything to yellow, and then from there I change my 61.8, which is the golden ratio, to red. The 38.2 to green, just to give me a better orientation. The 1.272 I add, and we'll go over that. The 1.414 I add, and this one's blue and that one's red. Everything else is yellow, right? Unlike this, if I'm overlaying 2 or 3, it can get really tough on my eyes, right? It's just more user-friendly. Now, defining retracements, right? We're going to talk about Fibonacci retracements and extensions. It is the same tool that we use. It's just how we're using it that defines whether we're measuring a retracement or an extension. Defining a retracement, is going to be a movement back towards the previous pivot, right? Most of the time, people say, oh, something's retracing, and in their mind it went up, or on their screen it went up, and now it's coming back down, right? And they think a retracement only happens to the downside. But it actually happened both ways, right? If something sells off and it goes back up to its previous high, right? If something sells off and then it starts moving back up to the previous high, that would be a bearish retracement, right? And just like you guys saw on BTC when we had this 61.8 and we'd continue up, right? Here we see a 61.8 and then we see a breakdown, right? And that would be a bearish retracement because price sold back down, and now it's retracing back to that previous pivot, so which is 0.1 on the fib. Failed it 61.8 and broke down. Conversely, that's the S&P, and here we have like a bullish retracement, and we get our swing low, right? Price moved back up, or price went up and then started retracing back down towards our previous swing low, towards our previous pivot. And then it was a successful bullish retracement at 61.8%, and then we continued upwards. Everybody with me? Yeah? Okay, awesome. So using the actual tool, deploying it, as I said, it was 2 clicks on a bullish retracement. You want to start your first click on your swing low, right? And then your second click goes on your swing high. And we're going to be using the wick of that swing low and then the wick of the swing high. And then we get our retracement levels. And on a bearish retracement, it's just the opposite. Your first click's going to be on the swing high, and the second click's going to be on the swing low. So you get a 1 up high, a 0 down low. Because where is this relevant? If the chart was to rally back up past that swing high, then it retraced 100%, right? And that's where the 1 comes from. And so this would be like going up 61.8%, it reaches 70%, and now it's like 100%, and we're going up to a new high. Same thing happened on the downside. So that 1, think of it as a 100% pullback to where price was before that pivot. The significant levels, there's only, I think, like 2 that you want to focus on, but these are the 3 significant ones. If a bullish retracement bounces off the 50%, so if you get a 50% pullback, let's go back. So if something comes down at 50% and stays up here and then rallies back up, right, that would be really bullish if it actually sticks. 61.8, that's your golden ratio. And there'll be a lot of examples of that. So when something pulls back 61.8%, like you saw that BTC 2016, 2017 chart, every one of those 61.8 retracements was bought back up for a bullish continuation, for a good trend. The 78.6, it's the next level down. And I haven't seen very many of those stick, right? The only 2 I can think of would be the BTC 2019 low and then Tesla during COVID crash. And these charts will pop up here in a bit. So generally, when we're measuring bullish retracements, we're either going after a trend continuation or we're going after a breakout continuation. To measure a trend continuation, I already mentioned that your swing low, your first click is going to be your 1, right, at a swing low, and your second click goes at a swing high, right? And here we're looking at Apple, and this is a weekly chart. So every one of these candles is actually 1 week of price action. And as I said before, at 50% retracement, right, which would be this next level here, right above our 61.8, that's pretty bullish. And it held up 3 times to sell-offs, actually 4. 1, 2, 3, 4. And here we had an extended run-up, right? And we see it happen, another retracement. Okay, so I went off on a tangent there. So big picture, what I want everybody to get out of the slide is whenever we're measuring a trend continuation. So if your asset class is doing great and you want to buy more on a dip, I'm not just gonna like buy these candles right here, these smaller pullbacks, right? I think the best entries are gonna be at deeper retracements, right, at a 50% level or 61.8, and the chart shows just that, where we had 1 50% and then 2 61.8 retracement from what are the numbers there? From like $15 all the way to $145, right? Whenever we're measuring a breakout continuation, right, this one gets a little tricky. Unlike a trend continuation, here we go up and then we sell off and we start a new move. On a breakout, we tend to have a resistance line, right? So where was resistance previously, right? Previous range or resistance. And if you just draw a line like we did on this chart, and we tend to have a breakout and a retest. So using that swing low of the retest, right? That would be our 1, up high would be our 0, and this would be our retracement levels, right? We got 28.6, 38.2, 50%, 61.8, right? These are the two important ones. And then the 78.6. And here's another example of a trend break, of a breakout. Right here we've got, it was Ether on the weekly, right? We got a nice resistance line, consolidation. We have a breakout. There wasn't a retest above, right? We didn't have a retest above the breakout. It doesn't mean we can't fib it. The proper method here would be to use the swing low just prior to that breakout. Make sense? Okay. And then if you look at how Ether actually reacted, there was a lot of support at that 50%. I was saying wicks or price rejection, right? And here it was basically all wicks in this range, above the 61.8, above the 50. So that's like a lot of buying pressure. That's a good sign that this 50% retracement is actually really bullish. And conversely, the chart went from $335 to $1,600, right? When the previous two methods fail, right, when you can't get a 61.8 trying to measure a trend continuation, and you try to measure a breakout retest, there's still going to be one more way to try to get a 61.8, right? And this would be looking at something like Uber right now, where using this swing low before the breakout, we'd already be sub 61.8. For some reason, maybe I have a bullish bias, and I think this chart's going to continue up. Right, so I'm still, I was still buying this 61.8. I was still bidding it. And what we would do is we'd use the previous swing low, right? And I think worst case scenario, if it is actually bearish, then we'll talk about extensions, and that's just in a few more slides. But using the same method that we did here, right, on Uber, if we apply that to the Tesla chart, right before the run-up before COVID crash, so like Q4 2019, Q2 2020, right? Using that same method, we get a 78.6 retracement and then continuation back up. So with bearish retracements, it's the inverse, right? It's just like what we saw with bullish retracements, just the exact opposite. A 50% retracement is going to be very bearish, right? So if something sells off, retraces back only 50%, continues selling down, expect a violent move down. Just like we saw Ether go from 300 to 1600, we'd expect that kind of violent sell-off. 61.8, that's the golden ratio. And 78.6, same thing, not as reliable, but some assets are going to do this more than others. So the S&P tends to do that. ES1 futures tend to do that. And you kind of want to think, is the trend over? Is this a bull trap, right? Or are buyers exhausted, right? And generally, I'm going to just go back just a little bit. Whenever we're measuring a bullish retracement or a bearish retracement, in our mind, we're going to assume that the trend is either bullish when we're doing a bullish retracement because we're buying the dip, right? Or if we're measuring a bearish retracement, in our mind, we already assume that it's bearish and we're looking to interact with it to short sell or exit a position on the bounce. So we're not trying to short support. We want to short that retracement up high. Bearish retracement measurements, right? Just like we saw that 61.8 play out on BTC on the way up. It's very similar on the way down, where we get a swing high and a swing low, and then a 61.8, and then it broke back down, right? So it was a 61.8. It didn't make a new low. But it did rally back up. And if you notice, there was a close up here, but then 2 days later, the open was below the 61.8, and that triggered the next steeper sell-off. And this is 2017 top through 2018 on the chart. And we saw this happen over and over. We get our 1, we get our 0. This was a 50% retracement. It tested it twice, major rejection. Big wick, right? Rejection once again, bearish continuation, right? Here we're assuming bearish continuation every time. We have our 1, we have our 0 to measure a bearish retracement from this high, right, to this low. This impulse up, just because the chart's going up doesn't mean it's actually bullish. It might just be doing a bearish retracement before continuing downwards. And this happened, once again, several times before we actually broke down all the way. So when it comes to structure and order of assets, right? When I saw that pullback from 60K to 30K and we had a 61.8 bullish retracement, in my mind, if I go from here to here and I get a 61.8 and that's my pivot, then the next destination, based on what this asset has done in the past, it has to be a 61.8 bearish retracement because it's going to retrace back up to that original pivot. When we're measuring continuations on retracements, it's always going to be your previous high, the correlating low before the move up, right? And that's going to be over and over, just like when we were doing the bullish continuation on Apple. Breakout continuation, the method, how do we measure those? Here we have like several breakouts, right? Before we get into the breakout, I think the real breakout is over here, down here, this bear flag, and this is the gold chart. I think this was like the previous era of gold being bullish. So we had our original all-time high and a pullback, and it developed a little bit of a range, right? The chart was stuck, and we have 1, 2, 3, 4, 5, 6 touches, right? Where did the chart fail every time? We can still have that same red line that's on my other charts, right? Every other chart I've had has that 61.8 red line, the golden ratio, right? And we happen to see failure there every time. So going through, right, we got our first, second, third rejection. At this point, we have a series of small breakdowns, right? So this would be like the first breakout. We have a 1, we have a 0, and we have a 61.8. And once again, we have continuation, right? That's our swing high, that's our swing low. That was a 50%. And here, if somebody was even late into this trade and they see this bounce, right, on gold, and they're like, hey, like I need to get out of my gold position. Are you going to sell on a down candle, or are you going to short on a down candle? You want to wait for a retracement, a bearish retracement to the previous pivot before you actually execute, so you get a better deal. And just like what we did with the breakout on a bullish retracement, right? So here we have our actual support. It's breaking down. We're going to use the very last high before the breakout in our swing low. And what happened was gold broke down, and it only retraced 50% before actually continuing downwards, right? So it's kind of a very bearish up move. A little fun bearish retracement fact, right? 2019, when Bitcoin went from 32 to 13,000, objectively speaking, that was just a 61.8 bearish retracement. Going from the previous high, right, at like 20K, which would be our 1, down to the bear market low, right? All it did was go up to 61.8 and then kind of come back down. Now, what happens in the case of an asset actually rallying past that 1, right? Like, are we done? We can't trade the retracements anymore? So if we go from measuring a retracement, a bearish retracement, right, and we get above that red line, right, the 61.8, where we saw failure before, and I showed you guys a lot of bearish 61.8 retracements that continue downwards. What happens when you actually get above it, right, and retest it and start going up and get past our 0.1, our past pivot high? At that point, we're actually entering extensions, right? And that's where the rest of the Fibonacci tool comes into play, because it's not just limited to your 1 through 0, right? Your 100% to 0 levels, which are the 28, 38, 50, 61.8, 78.6, right? We have further extensions that give us upwards targets. Defining extensions. So definition of extensions is going to be a chart rallying past the previous pivot. So if our pivot 0.1 on a bullish retracement was down here, right, and the chart actually makes a high and then comes back down, the 61.8 doesn't hold, and it actually sells off further, right, that would be a bearish extension because it's extending past 0.1, right? And here we see some extension levels holding up, major rejection, a close an open above the 1.2, then a rally up. Conversely, same thing happens to the bullish side, right, where we have our 1 and our 0, and once we break past, once price action breaks above that 1, right, we get these extension targets. And they tend to provide us with a schematic of what's going to happen in the future, right? So if somebody's looking to buy the dip or counter trade a breakout, this would be a great place to come in and do that when we see that rejection at these fib levels. And conversely, this is the S&P weekly, right? We had 3 retests of this 1.272 from the top side. So say you got out of the trade and you're sketchy about markets, and you see it drop down and you know, reject the first time, the second time, you see it a third time, and you see bulls coming in and buying it up, you see rejection, probably a good time to get back in because that level is holding, right? The chart's not pivoting for no reason. Most of these pivots are going to happen at key levels. I covered that. I feel like I talked a lot on that previous slide. All right, so significance of extensions. You're going to let us know when to counter trade an impulse, right? You're going to help us target set and tell us when to buy back. And we're going to be able to look for price tests and retests, or missing retests. The extension levels, the standard ones that you're going to get on your actual trading view are going to be these guys, 1.618, 2.618, 3.618, 4.236. Next up, the bubble levels. I actually sat down with a friend of mine, and we studied a lot of assets that just kept extending and extending and extending, and we came up with, we crunched some math, and we found the 6.54, the 1109, 17.94, 23.6, and actually it was 61.8. And this is Tesla going up, doing the full. I can't see the numbers on there. This is a full like 61.8. So Tesla actually ran up through all of these from $3 to the $6. So this little range, right, extended on Tesla. It gave us an upwards target of that 61.8 Fib, right? And that was actually the top for COVID crash too. And then the chart pulled back, right? And then we continued back up. So we were able to get a target up here for a pivot based on this little range in these series of numbers. And then there are the tricky levels, right? I don't like talking about these a lot, the 1.272 and the 1.414, but I'll show you guys why they're tricky and where they come into play. Extensions in practice, right? Here's some like 2 popular IPOs that just happened. Or one of them is recent, the other one's old. But this is Robinhood, right? Who's in Robinhood? Who bought the IPO? Anybody? Nobody bought Robinhood IPO? Okay, all right. So going from the swing high of the actual listing down to the very swing low, if you click our 1 up here and our 0 up here on that fib tool, right, it would give us extensions. It actually rallied up to the 6.54, and interestingly, I don't know if I can zoom in. I can't zoom in, but that 15-minute close on this candle was actually right at our target, right? At this point, we're thinking, hey, is this done, right? Are we going to come back down and retest these levels below, these extension levels below? And that would be a very bullish IPO, right? And if you got in and you took profit there, then you kind of know where to look to buy back. And in the case of a bearish IPO, this is Snap, right? We had our initial sell-off develop, and then we have a range. And if we extend this 1, right, to this 0, and we're looking for retracement. If it stayed here, that would have been great. That would have been a 61.8 retracement. We can keep going up, but that didn't happen. What ended up happening was it extended below our 1, right? And then it broke down past the 1.272, past the 1.414, and it came down to the 1.6 Fibonacci extension. So by just having this much data on the chart, like just having this range, we're able to get targets below in case it starts dumping, and we can actually get some targets or look for potential zones to interact with the chart, to buy, right, or to stop shorting. Instead of just buying in no man's land. Like, anybody bought in a snap when it was crashing? You guys did? Like early? Like post IPO? Okay, nice. Okay, so yeah. And I don't know what you use to make your buys, but if you apply something like this on your charts, you can get some pretty good entries. Now, conversely, these same two charts, right? We talked about bearish retracements happening when we see something like Robinhood go up, right? Make that little blow off up high, but actually not close above our 6.54 fib extension, and then we see it sell off and then retrace back up, right? I mean, most traders are like, oh, Robinhood sold off, I'm going to buy in because it's now going back up. But I mean, all it did was a bearish retracement at that point, right? And it did a 50% retracement, and it couldn't close above. We had 3 nice rejection wicks, and at that point, it's probably a good time to exit the trade if you're in it for a trade, right? If you want to extract your value out of the market, or if you actually want to buy puts on it, that would be like a great entry. That's what I did on AMC. It's not, I don't have an example, but I can pull up the chart when I'm done with the slides and show you guys when I shorted AMC after a bubble, the second time. The first time I got stopped out. But so back to Robinhood, once we got that 50% retracement that failed, the chart just kept going down, right? I think it's still going down. And now it's likely to interact with the 1.6, the 1.414, and 1.2. We want to see some kind of rejection, some really nice long wicks, and followed by up candles. The snap one looks pretty confusing, right? Which is the one right next to it. But all I did here is two fibs on top of each other, right? We can combine them to get our extension levels, and up high, right, our bullish extensions, and we can have our bearish extensions. And what happened with snap was really interesting, because if you take our swing high, right, up here, the highest high of the IPO, right, and down to the lowest low, the 61.8, right, just the red line. I don't have quite the price there, but this would be that initial rejection, right? So snap rallied up, did a 61.8. That's a bearish retracement, and then it kind of continued back down. It actually rushed back down, and it held up at that 1.272 from the previous move, right? So when we overlay this tool, the fib tool, we get a schematic of where can we possibly get a pivot, right? It's not giving us predictions of like ADA's going to be at X amount of dollars in 6 months, right? No, but it's actually enabling us to get an idea of where's the best, most optimal place for me to interact with this asset class. Extensions in practice, right? So back to the tricky fibs, right? So I don't like talking about those much. If you look at the S&Ps, this was like the 2000 crash, right? This was 07 crash. We look at this move, and some of us are thinking, "There's no way you could buy that, right? Like, market's going to zero. I'm throwing in the towel." But if we actually zoom in, and we just take, the market leaves signs. There's a wick over here and a wick up high, right? A wick low and a wick high. And if you extend these, right, it actually came down to 1.272, a wick below, but it closed above, and then it continued up. So this move here was just a 1.272 of an extension in that range. Yeah. I can't hear him. Right. Another thing that's really important is retests of extensions, right? So when we get some really big exaggerated moves, the reason I wrote the paper in December 2019 saying both markets are going to crash is because I was just doing a fib analysis of BTC bull markets and traditional market bull markets, right? And I found out that when they start extending above certain levels, it doesn't happen at random. They're both risk on, and then they both go into corrective or risk off. They don't correct the same way. It's not a one-to-one correlation, but when one market's risk on, the other one is risk on too. Or maybe it's about to correct. If one of them's correcting, the other one is about to correct, or it's actually correcting as well. You'll be able to see it in hindsight. That paper is on Medium, right? It's called Risk On and Greed Cycles, if you guys want to read it. And it's just a bunch of charts with this and annotations. But what's really important is you're up here, right? And this was December. This was actually like further in. In December, the S&P was like 7% extended above the 2.618 with no retest, right? And I'm sitting there and I'm looking at the history of this index, and it's retested every single extension level, right? You have a retest here, retest here, retest here, retest here, right? Retest on the same level. This was a deep retest, but it's still a retest. And once we broke above, we didn't quite have a retest on the weekly scale. I'm like, hey, this thing's gonna pull back. It's gonna dump. BTC is basically doing the same thing. Actually, still stuck in a bearish 61.8. So when there's a missing retest, like we look at markets now, right? We are having a missing retest, and it seems very like frothy, right? So I mean, if somebody's got money on the sideline, right? You want to buy the froth, or you want to like be able to get in on one of these retests, right? So using these extensions, we're able to get a lot of data, right? And what could possibly happen in the future, and where are we now relative to the levels that are just below us? Have we retested them? What did that retest look like? Wait, awesome, almost done. So. All right, so when a bearish 61.8 retracement fails, right, and price rallies above that level, right? So here we've got our 1, we've got our 0, price sold off. What is this? Apple. And then we got our pivot. This is our pivot, and then price went back up, right? We had a rejection at the 61.8. It failed the first time. It failed the second time. The third time around, it broke above, right? Retested it shortly, and then we started seeing that continuation, right? So generally speaking, like coming out of COVID crash, a lot of stocks that I traded were still sold off, and I wasn't just like catching bottoms, but I was trying to get in on the like really nice upwards volatility cycle, and I would wait for things like a top-down retest on a 61.8, and then I'd buy calls like at the money, and I'd buy calls out of the money that are far in advance because everything was oversold and just rallying, and the Fed was printing. But what that enabled us to do, right, is to get a system, right? So if something breaks above that 61.8 bearish retracement level and retests it, it's likely going to see continuation, right? Whenever something gets above here, like 78.6, I don't really like to short it unless it's like the S&P or ES1 futures. But the level I want to short is that 61.8, and if it breaks above and retests and it's positive, I'm done shorting and I'm looking for a long. We see that happen again, right? The first time we touched it, Apple touched the 61.8 on this swing, it was rejected, right, and came back down. The second time it went above, the top-down retest was actually a failure. The third time around, the top-down retest was a little check mark, right? Price stayed above, and we saw that upwards extension take off. And then we see it happen again over here, right? So it's a second test. And then here, that was that September, the September blow-off top, just like not too long ago. I don't know if you guys were trading that. When everything went up, the VIX went up, everything came down, and the VIX kept going up. Coming out of that, Apple had like a 61.8 bearish retracement, right? So that was a good place to exit any calls I was still in and then flip short. But then moving on, right, we had a breakout above, a retest that failed, and we still had one last chance to get in that trade, really stretching here, to get in that trade before getting up from the 61.8 to the 1.2 and the 1.414. All right, so if there was such a thing as universal order, right? If markets had an order, if they weren't random, right? Could financial markets have a blueprint, right? And I think that's the case, right? This is BLX, that's the Bitcoin index from when it started, and everything almost correlates with fib levels, with extensions. Even we do come back and hold at previous levels, right? And ironically, where is this? That 65,000 high that we just had this year, right, was the 61.8% fib extension of this previous range of like, what was the high? Like $1,300, right? Just like what we saw in Tesla. Yeah, I think that's about all I have for tonight. I'm gonna take some questions. If you guys want me to like chart some things live, I can do that too. Like show you how to use the tool. That's fun for me. So sweet. I got questions in the back. Yeah.
Yeah. How much do you use sentiment analysis along with
Sentiment analysis?
Yeah, especially when it comes to like cryptocurrencies.
So no, okay, so I don't. So the only place order flow comes in is you're familiar with like tensor charts? Are you familiar with tensor? No. Are you familiar with like the significant trades website? Right. So the only time I use anything other than fib levels is if we're at a 61.8. Right. I turn on that significant trades because I don't have time to watch the volume. I want to hear the volume. You know what I'm talking about? The audible volume?
So you're just using it as a confirmation?
I'm using it as a confirmation, and that's it. A lot of times on the CoinOBS Twitter, I'll post like, hey, do you think BTC can close above this price? I'm already short, and I'm just trying to see who else is making a donation, right? Or, you know. Yeah. No. Next. Good.
How do you use a time extension?
So the tool exists, right? And I don't think it's usable, right? We can't really predict things out in time. We can't. I think the closest thing you can get to like predicting things in terms of time is like a TD sequential indicator, right? But not all assets follow it. But there's no way. I mean, maybe if I spend as much time trying to figure that tool out, I could tell you. Maybe in like 10 years we'll talk about it or something, but maybe I don't know. Okay, all right. Any other questions? Good.
Well, you might like GAN analysis for the GAN so when I do Fibonacci extensions or retracements, actually, like I do the squares or I do it to the end power. In other words, 1.618 times 1.618 is 2.618.
Okay.
Times 1.618 again is 4.362.
Right.
Keep doing that, you get to that 11 number, the 18 number, keep going up like that. So it's like I do that, and then I also on retracements, I do the 61.8 retracement, but then also there's 50. And then 38% retracement is 0.618 times 0.618 is 0.382. But I do another one that works a lot in crypto, so it works off in the stock market. But I do the cube, so 0.236 retracement. I noticed you said that you use the 50, the 61.8, and also that weird one that I see on all the software, the 78.6.
786.
Yeah. Now I don't understand where does that one come from, and where did your other non-cube, non-square, non-exponent numbers come from there? Like, why is 3.618 meaningful? Why are some of these other meaningful that are not an integer exponent?
I mean,
Either the 0.618 or the 1.618.
so I said I wasn't gonna get into the math of things, right? And I'm not gonna cover the math of how those numbers exist, but I lost my chart. So if you can get numbers, right, and if you can get pivots at those charts based on those numbers, right, and your numbers are following like the fib sequence, then use the numbers that are working for you, right? If you're getting a movement to those extensions and they're acting as true extensions and they're causing some trouble for your asset, or if an asset retraces back down to your numbers and you see like a big wick there, volume come in, maybe you're tuned into something that we're not tuned into, right?
Okay.
So.
Why do you like the, because I can see that it works on there, you showed
Yeah.
pictures of it, but like, why does the 78.6 work? Like, where does that come from? Related to the Fibonacci sequence, in other words? Like, what
I haven't done the math behind it, but that's like a standard. That's a standard one on most platforms, right? So I didn't have to like question it. I just try to figure out where to apply it. Does that make sense?
Yeah.
All right. Yes.
I guess this is kind of an opinion, but where do you think that toward the rest of this year the crypto and the stock market is going towards?
So we were talking about 61.8 retracements, right? The reason I wrote BTC like 3 months ago when we were at 30K, I said 48 is the next high or next pivot, right? It's the next logical target, was because that was a 61.8 retracement of that move, and that would have been a bearish 61.8 from 60K to 30K, 64 to 30K back up to 48. That would be a bearish 61.8. So at that point, until we close above, right, and rally above that 61.8 retracement, we're expecting a bearish continuation, right? That being the case, and based on what I've made observations on traditional assets and their correlations, I think we're going to be, I feel like we should enter a little bit of a risk-off environment, or at least a repricing, because we had such a huge run. A few, like 2-3 weeks ago, I put a model together saying we should expect something like what we saw in 2018 in the stock market, where it was like a pretty choppy year where it did this, and it was like that Christmas crash, right? And then the Fed made the call, and it was like a 1.272 extension of that range, and that's when Mnuchin made the call, and then the PPT came in, brought the market back up. So we should see some kind of revaluation of assets. That's what I'd like to see, like some rotation of funds. Yes?
Sorry, just as you mentioned 1.272 again, where does that number come from? That's the square root of 1.618 is 1.272. It's the only way to remember this number.
Nice. Okay. Yes?
Do you ever use the information from the data to put their calls to understand that where are the buyers?
Puts and calls? So do I look at order flow on options?
Yeah, but to the forecast where the market is, where the buyers are.
I have a subscription to Market Chameleon, right? Yeah, and it gives you like options, and it just shows you where the volume is on options, right? There's a saying like follow the money, right? But I'm not gonna make a trade that contradicts my fibs, right? If I see a lot of calls at like a 61.8, but the sellers are, there's still like those nice rejection wicks and it's still selling off, I'm probably gonna buy some puts. I'm not gonna like do a call sweep just because there's a call sweep happening. Yeah. Yes.
At what point do your bid levels become a self-fulfilling prophecy because everybody's looking at them and
So here's the thing. You get on like any trading community that I'm not affiliated with, and you say fibs, and 98% of the traders be like, fibs don't work. And the reason they don't, it's just like the arrow in the Indian, right? It's not usually the arrow, it's the Indian. Yeah, so there's a big disbelief, and there's not really like a resource, a book that explains this stuff, and I'm actually working on a book about using the methods I spoke about. And yeah, so I don't think there's enough resources out there for them for no longer to work. And even if there were, I still think we still see these moves. It might stop working on certain assets, but why would you trade an asset that you don't have an edge over, right? So you just find an asset that's complying. That's it. Well, thank you. Thanks, everybody. Thank you so much. Thanks.
Why
was like George. Thank you all so much. Thank you, George. I also want to extend a special thank you to our crew. We could not have done this without Sarah, Alex. And especially to the crew of the monastery. Thank you so much for having us.
Yeah, the slides? Yeah, how do you want them? Okay. Yeah, well, do you have like a list of everybody's emails or something? Sweet, awesome, we can do that.